Will the new year be Scrooge-like on the economic front? We're taking a Dickensian look at 2020 with Beth Ann Bovino. She's S&P Global Ratings Chief Economist. Beth Ann, we took a cue from you because this is kind of how you structured your report. You had a little fun with it here. You say there are fewer Scrooge-like indicators in the forecast. Why would you say that?
Well, it's looking really, well, there's a couple of things. One, I want to say that from the offset, domestic side of the U.S. economy was holding up relatively well. We had jobs strong and wages climbing higher, all good news, and that helped people spend. The worry we had was the international side of things, and there we're getting a few more presents under the tree because we're seeing some compromise with the U.S. and China, a mini deal, if you will, as well as USMCA. Looks like it's going to be ratified. All good news, making businesses feel a little bit more comfortable spending down the line.
So help us make heads or tails of something that was in the Yahoo Finance morning note. It talked about, we all look at certain things, but we should be looking at the U.S. economy in relation to the housing market. We got strong housing data this week. Does that really set us up going into 2020 for gains across the board, or is it specific to housing?
Well, when you have strong housing, that means a rule of thumb is that for every home built, that usually means 2 or 3 jobs are created. Why is that? It's not just in housing. Construction certainly benefits, but you also see retail getting a boost. Also, mortgage business gets a boost as well. People start to get jobs, people start to spend. And you have to say, when people buy a home, they have to fill it with a lot of stuff. So that also supports for all that furniture and appliance spending as well.
Yeah, with the consumer being strong, I would expect that the housing continues to sort of stay in positive territory this year. But what do you think about retail and consumer discretionary? And do you think that the consumer being 70% of the economy continues to hold us up in 2020?
I do. Look, it remains to be seen. Many things could always change. Things could change. However, at this point in time, with the jobs market, we're looking at job gains now for 2019, averaging at around, I guess, about 180,000. Really nice reading. We do expect it to slow, but that's actually because we're reaching full employment in the United States. It could be around, say, maybe 125, which still means it still keeps up with demographics. Wage gains, we're looking at probably over 3% year over year next year, also a positive sign. And because looking at the equity markets and also household financial balance sheets so strong, that means there's more money to put down payments for those homes. Maybe not for the kids, but certainly for mom and dad who want them out of their basement.
And what is all of this going to mean for wage growth, right? Because that's something that full employment would imply more robust wage growth, which has not materialized yet. Does that change in 2020? What's going to make it change, if so?
It has been, wage gains has been rather slow, given we've seen such strong jobs numbers. I do want to note that while we're looking at wage gains now over 3% this year, and we think it's going to hold that way for next year, keep in mind where we were just a few years ago when wage gains didn't keep up with inflation. We were actually paying people to let us work. Now we're seeing a stronger reading for that. We don't necessarily expect to see wage gains picking up dramatically faster next year, but again, it's still going to be a slightly fatter paycheck for people to spend.
Let's also talk about the trade disputes and how they've impacted markets. You believe that international equities could be poised for growth next year, but poised is not definite. So help us understand what's happening with trade right now and what we could see in 2020.
What will help markets? What will help equity markets? Will help investors feel free about putting more money down on an investment is basically less uncertainty. One of the worries we had for the U.S. economy was that this uncertainty, a so-called crisis of confidence, both in markets and in business spending activity, would actually just shutter pocketbooks. With the trade dispute sort of calming down with the U.S. and China, at least the mini deal that seems to be in place, that gives businesses reason to open up their paychecks, open up their pocketbooks. Sure. One of the worries we had earlier on when we had a higher risk of recession just in August, one of the worries we had was that would we start to see businesses who had actually started to slow down on investment, would we start to see them shed jobs as well? That doesn't seem to be happening, and that's a positive for 2020.
Consensus seems to be looking for a reacceleration of growth next year. Is it possible that it gets almost too good? Because we have central banks as a tailwind right now. We might have rising interest rates, a rising yield curve. Do we get to a point where we no longer have the central banks at our back, and is that actually becoming a headwind at some point next year?
Well, we do see, we also see growth. Actually, we actually upgraded our forecast for growth to closer to 2%. It was around 1.7 in August when those trade tensions were actually weighing on us. However, I would say in terms of the Fed, we think the Fed is probably going to basically stay on hold now, stay on hold next year, largely. And put it into perspective, isn't that a good thing? That means they think that the economy can stand on its own. They don't need to prop us up, and that's a positive. Now, in terms of whether they're going to move on further rate hikes or further rate cuts, or could they move for a hike instead? Right now, we think the Fed's going to stay, basically hold the line next year. If they move in 2021, likely going to be a hike, but that also depends on how the economy will be.
Right, and wage growth.
And wage gains as well.
All right, Beth Ann, thank you for being here. Beth Ann Bovino of S&P Global Ratings. Appreciate it.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.